Hello traders, welcome back to the Forex Geek channel where we dive deep into the tool that can help you make smarter trading decisions. In today's video, we are going to be talking about the most effective Forex trading strategies that are delivering consistent results in the today market condition. Whether you are just starting out your trading journey or looking to refine your current approach, this strategy will give you a clear framework for analyzing and executing trades. Now there are 4 top strategies breakdown. Let's examine each strategy in details. We start by the most reliable setup that you can implement immediately. The first strategy is the 50 pip strategy. Now the 50 pip strategy is a momentum based strategy that captures the initial move at the London Open, typically occurring between 7 a.m. to 10 a.m. GMT. This strategy capitalizes on the high volatility during the London Session Open, specifically designed for major pairs such as the GBP USD and the Euro USD. Now let's look at an example on the chart. After our Asian section, we look at when we start the London section. The London section starts by 7 GMT, and you can see from the chart this is the 7 GMT, capitalizing on a move from the 7 GMT to 10 GMT, as we can see from the screen. First of all, if you want to enter your trade, you have to wait for the 7 a.m. GMT open candle. This is the candle. We wait for the candle to open and close. When the candle is open, we monitor the first 15 minutes candle formation. This is the first 15 minutes candle formation. We look for a strong momentum candle, minimum of 20 pips. This is a strong momentum candle with a minimum of 20 pips. Let's use our price range, our pips calculator, and we can see that this is 10 pips. This is a 10 pips candle. So let's look for an example that has a 10 pips, a 20 pips candle, minimum of 10 to 20 pips. After we see a momentum candle, a strong momentum candle of minimum of 10 to 20 pips, this is a 10 to 20 pip minimum candle, we enter when price break the high or low of the momentum candle. Once price break the high or low of the momentum candle, as you can see in this example, price broke the high, we enter our trade. When we enter our trade, they have primary exit rules. The first primary target should be at least 50 pips from your entry. You can target 50 pips from your entry. 50 pips from your entry should be your first target. Your second target should be your second target can be major support or resistance level. You can use previous major support and resistance level to exit your trade. But from this example, I can't see a previous support or resistance level. So let's use most recent price. Let's look for a most recent price action. Okay, this should be a very good example. After our momentum candle and the break above the candle at this area, we can target, either we target 50 pips or we target a previous support or resistance area. This is a previous resistance area. This should be our first target. This can be our first target, or we can target 50 pips in profit, or we can make use of trailing stops. Once we have a 30 pip move in profit, we can decide to trail our stop loss to secure more profits as time goes on. Number 2 strategy we'll talk about is the swing trading strategy. a multi-day trading approach that identifies reversal at key market levels using multiple time frame analysis to capture large market moves while requiring less screen time. Now this approach will make use of the Fibonacci retracement. For a swing trading strategy, we make use of the Fibonacci retracement, also using the higher time frame. We can use the 4-hour time frame, or we can make use of the daily time frame for this strategy, because we are trading a swing trade setup. Okay, from the chart we can see that this is the 4-hour GBP USD chart, and I will explain how we can make use of this strategy in this chart setup. First of all, we have to identify our direction of the daily time frame. From the daily time frame, we can see that at this area in market, price is trending to the downside. From the daily time frame, price is trending to the downside, showing us, yes, there is selling pressure in the market. So we switch back to our 4-hour time frame. After we have determined our trend of the market, we have to look for pullbacks. Now, how do we find this pullback? We can find this pullback by using our Fibonacci retracement levels, by drawing from the recent low to the lower low. I repeat, we can draw our Fibonacci from the previous high to the lower low in case of a bearish market, and we look for pullbacks to key Fibonacci levels. These levels are the 38.2 level, the 50% level, and our optimum level, which is the 61.80 level. We have to wait for our candlestick reversal pattern to show or indicate itself on these particular levels, on these particular Fibonacci reversal levels. After that, we can confirm using our RSI divergence. We can confirm using our RSI indicator. Using our RSI is to find if price is being oversold or overbought in the market. We also use volume. We also use our volume indicator for momentum in the market, to confirm if there is really bearish momentum in the market, which we can see at this point in the market. We can see that price, the volume indicator was showing that there was a strong momentum in the market. Now, how do we manage our risks? If we are to enter at our optimum area from our Fibonacci level, how do we manage our risks? We put our stop loss just below or just above the most recent structure. In case of a bearish market, we put our stop loss just above the recent structure, or above the trend line, or above your support or your resistance level. This is to give your trade some breathing space. Then our first profit target should be at least 1:2 risk to reward. This should be our first profit target, 1:2 risk to reward, or we can target 1:3. We can also target the previous low in the market, or we can target a structural level, a level in price that we are expecting price would form a resistance at that point. This level is a typical example. After that, we should always remember that we shouldn't risk more than 1% of our account, meaning that our position size matters a lot. We should always risk nothing less than 1% of our account. You should also confirm that the RSI is in the oversold region, which is below 30. And if you can see from this area in the RSI indicator, we can see that price is trading in the oversold region, signifying that price is heading towards the downside. Now the third strategy we can use is the precision scalping method. The precision scalping method is a short-term trading strategy focusing on small frequent gains using tight spread and precise entry during high liquidity periods. How do we enter the trade using this precise scalping method? We enter the trade, first of all, we have to make use of indicators such as our EMA. We make use of our EMA indicator, our moving average, our exponential moving average. We set up our exponential moving average to 9 and 20 moving average respectively. Setting this up, we also change the color to make it different. Okay, very good. The smaller moving average, which is the 9 moving average, is the blue line, while the larger moving average, which is the 20 moving average, is the yellow line. First of all, while trading, the first rule we need to know while trading our precision scalping method is we should only trade during major sections. Major sections like the London section, the New York section. These are the most volatile sections that we should trade during this time. Then the EMA, the 9 EMA and the 20 EMA must align with trade direction. I repeat, the EMA, the 9 EMA and the 20 EMA must align with the trade direction. So we should be trading in the direction of the market. We can also make use of the RSI indicator, the RSI, the relative strength index, to also confirm our overbought and oversold market. When the RSI is above 70, it means price is being overbought, and when it's below 30, it means price is being oversold. Always remember that when you are taking this strategy, you need a minimum of 1:2 risk to reward ratio. When you risk 20 pips of your 20 pips, you should get at least 40 pips in return. That is what I mean by 1:2 risk to reward. And don't forget, you have to trade pairs that have smaller spread under 1 pip. Now, how do we manage our trade? We manage our trade by at least risking 0.5% of our account per trade. You should always use a stop loss while trading, and your stop loss should be a maximum of 10:15 pips. 10 or 15 pips. Your take profit level should be twice that of your stop loss. That's if you are trading, if you are using a stop loss of 10 pips, your take profit should be at least times 2 of what you are willing to risk. Then do not open more than 3 positions in a trade. Do not open more than 3 open positions in a trade. Now let's see an example. When the smaller EMA crosses below the larger EMA, we take a sell trade at this area. We put our stop loss just above the EMA because we are scalping. Then we ride the wave downward. We take 1:2 or 1:3, then we are out of the trade. Don't forget, this is a scalping trade. You are just in and out. Don't forget to confirm your position with your RSI to see if it's in an oversold region, which it is. It is below the 40 region, which shows that we are in the oversold or oversold region. That's where we are. Now the fourth strategy we can use is called the position trading strategy. The position trading strategy is a strategy that involves the higher time frame, a longer term trading approach to the market. We trade using the fundamental and the technical analysis to capture significant market moves over weeks and months. Now, changing this to my higher time frame, like my 4 hour or my daily time frame. Let me use my daily time frame for this example. We have to, first of all, we know the direction of the market. We know the direction of the market. Using this trend line, we can see that market is trending towards the downside. We can use higher time frames. We can confirm our trade using higher time frames. But for this example, I will use the daily time frame. We can make use of the daily trend so that it will make price clear to us. We can also confirm our entry by using price at major support and resistance level. Major support and resistance level. These are areas where would give us potential resistance in the market. These are the major support and resistance level in the market. These areas are places that price took its time to cross. We also need to have a fundamental analysis to support our direction. We should always consider the fundamental part of the market because it helps us confirm our direction in price. The monthly chart shows a clear trend structure too. You can also make use of the monthly chart because the monthly chart is the highest time frame, and I believe it has the time frame. Each chart holds more confirmation. If the monthly time frame is telling you that we are expecting a bullish trend, we should know that yes, that we are trending towards the upside because of the significance of the monthly time frame. Then we should also consider using our volume. Our volume helps us to confirm price action. When we see an increase in volume, it shows that yes, there is much activity going on in that area of the market. Now, how do we manage our risks? We should always risk at least 2% of our account per trade. Let's not forget, we should risk at least 1 or 2% of our account maximum. Secondly, we put our stop loss beyond the major structure point when taking trade. If we are to take a trade at this area in market, when price came to break this area and retest and broke this zone, we are going to enter the trade after it has broken this zone. We put our stop loss just below the major market structure point. You can add positions at key levels. You can scale in at key levels. If you believe the market is going to continue going to the upside, you can decide to scale in or add more positions to your trade. You can add more positions at key levels just to ride the momentum to the upside. And don't forget to put your stop loss just below the recent major level. We can take profits at major psychological levels. Psychological levels are round numbers. Numbers ending with 00 or 50. Those are major places that we can take our profits at those levels. Alright traders, we have come to the end of this video. Engage with us in the comments below. We want to hear about your experiences. If you found this video helpful, do not forget to like, subscribe and turn on the notification bell so that you wouldn't miss out on more trading tips and strategy. Thank you for watching, and I will see you in the next video.